Hi everyone, welcome to Dezerv's monthly market update. We have our co-founder Vaibhav Porwal with us. So Vaibhav, the market has a lot of polarized views this time, right? There are certain investors who believe that there is a lot of euphoria in the market, whereas there are certain investors who believe that certain pockets of the market are still going to do well, right? So what is your take on it? Do you think there is euphoria in the market?
Both these arguments have certain merit. So when you look at people who are saying that there is significant amount of euphoria in the market, obviously they are looking at a segment of the market where excesses are getting built. When you look at SME IPO exchange, and I am bringing out SME IPO exchange in this conversation because that's been something which has been a focus area for everyone. When you look at the data point of SME index, in last 10 years, the index has delivered 66% CAGR. That means there is high degree of euphoria which is playing out there. When you look at derivative segment of the market, the activity continues to go up, and which is leading to this belief that there is a significant amount of euphoria which is building into the market. Now looking at the alternative view, when we talk about investors who believe that there are still pockets where value is there in the market, there is strong merit there also. If you look at Nifty 50 for instance, in last 5 years, the index has doubled, which is in line with what the market generally delivers. So I don't see any excess which is getting created there. Now coming to the behavioral aspect. In India, we are seeing this emergence of equity cult, and this equity cult will continue. This equity cult and the liquidity which is coming in the market as a result of that should get channelized in the right instruments and right quality of companies, and that is what our focus should be.
So Vaibhav, as per SEBI's latest report, 9 out of 10 traders are losing money in the F&O trading market, right? And as you just said, there's a lot of money that is moving towards equity. So how should investors create wealth from the equity markets?
Well, in equity markets also there are two types of investors. So first set of investors are investing money in equity mutual funds. They continue with their SIP and they have created significant amount of wealth. Now the second set of investors are not investors, they are traders. They are looking to benefit out of sharp movement in the market over a very short period of time. So there is a data which tells you that average holding duration of these trades is less than 30 minutes. So they are not looking to invest for long term. What they are trying to do is to benefit from sharp movement in the market over a very short period of time. Now these investors are essentially playing a game of lottery, and as human beings we assign too much value to the events with very small probability, and that's why lotteries exist. So it will be unfair to club both of these segments in one single category. Both are trying to achieve different objectives. Investors who are investing in SIPs are disciplined about it, are looking to create wealth for a long period of time. And we've seen the SIP flows. Last month also we saw more than 20,000 crores of money coming into mutual funds for SIP. They are looking for long-term wealth objective. At the same time, we are seeing this behavior where traders are trying to take advantage of short-term movement in the market and create wealth out of it. There are few success stories, but they get amplified. As you said, 9 out of 10 lose money, but there is that one individual who is making money, and everyone is trying to take inspiration from that one individual. But eventually, it's a game of probability. If 90% people are losing money, that's the biggest truth in the game.
Understood, Vaibhav. I mean, that definitely puts the trading and investing into perspective. So right now, how an investor should approach investing, and specifically how are our strategies placed in the current market?
No, it's a very relevant question, Akriti, and I'll take my personal example to build on this. See, one thing which always helps in the market is time in the market. In 2007, when I was investing, and I was investing for 2-3 years, that was the first time I experienced a deep correction in the market. My portfolio's value went down by more than 50% in 2008, right? So 100 rupees that I was holding in 2007 went down to 50 rupees in 2008. Fortunately, I stayed invested, not because I had any specific insights, but I had time on hand. Today, the value of that 100 rupees is 500. So time is something which can solve for short-term correction. We saw a repeat of that during COVID also. Markets fell by 30%, but investors who stayed invested were able to recoup their losses and also create wealth for themselves. So first thing first, invest only that pool of capital which you can invest for a long period of time. Second, the other issue that we need to be careful is the kind of advisor or kind of investment manager that we are selecting. There are a lot of platforms, there are a lot of apps which are not regulated, and regulators have expressed their concerns around that. So make sure that you are investing with investment managers who are regulated by SEBI. Third thing, invest in businesses or invest in companies which are going to be there for next 10, 15, 20 years. It's important that your money is invested in quality businesses. So these are the three things that investors would do. And we applied the same principle in our flagship strategy. We are investing in companies which has a durable moat, which are going to be there for next 50, 100 years, and looking at businesses which has significant quality and valuation comfort. All these portfolio decisions are taken with the point of view that investors have extremely long period of holding requirement, and therefore will be able to continue to generate returns for them. Now, one thing that I would want to address here is investors need to moderate their expectations on the returns. We have seen significantly high returns over last 4 to 5 years. 25% returns have become a norm. But honestly, when you look at the markets from a long-term point of view, 14 to 15% is the returns that everyone should expect. I am not saying that these returns will be linear, but that's been the average returns for the market. So that is something that investors should keep in mind.
Vaibhav, my last question for you is that what are the factors that investors should look out for in the coming period?
So let's start with the most talked about factor, which is interest rate cut. The Fed has indicated that they are looking to reduce interest rates, and the extent is yet to be known, but there will be significant reduction in interest rates. Now, one thing which is very clear is that interest rates going down does not always mean markets going up. In fact, when you look at the data points of last 3 Fed interest rate cut cycle, every time US markets have reacted adversely to it. And in some sense, people are correlating that with what Mr. Warren Buffett has done. He is sitting on significant amount of liquidity after liquidating his large position in Apple stocks. Now, why does it happen? Interest rates go down only because economy is slowing down, and if economy is slowing down, corporate earnings are also likely to slow down. Therefore, to make this one-to-one correlation between interest rates going down and markets going up may not be right. So it's important that we look at all these events in the context of the impact on the markets and economy. Now, from India's point of view, I think it will be positive because FIs have largely stayed away from this up move in Indian equity market. But with cost of capital going down, they are likely to resume their allocation to Indian equity market. So that's one positive. From India's point of view, there are 2 points that one should look at. First, monsoon. So far it's been all right. July and August has done some catching up, and that will give some breather to RBI if inflation slows down on account of that. Now, the third thing which is important is we've seen some slowdown in economy, and that slowdown may start impacting the corporate earnings. We should be very careful. We should carefully track the corporate earning trajectory before deciding to allocate money in equity, and also moderate our expectation of return. So these are some of the things that we are looking at.
Great, Vaibhav. So that definitely gives investors a lot of perspective on how to approach the upcoming market, and we shall see you in our next month's monthly market update.
Thank you.